Welcome, everyone. Welcome to this edition of Crashes and Taxes. I am your host for the podcast, Rebecca Walser, and I really appreciate you guys joining me for this market or this podcast, Crashes and Taxes, about the market. I have been my schedule for April and May is jammed, packed. It is so busy. And so I really appreciate you guys bearing with me. I think June is going to slow down a little bit, I see. And so, I will be able to do longer podcasts like I like, with more charts and more details. For now, I'm just trying to give you guys a weekly kind of update of general high level, what the heck is going on, so that you can stay on top of everything. But we'll get back to more in-depth podcasts once June comes. But right now, I am really slammed. So thank you for bearing with me, and let's get started for this week of May the 2nd. When I'm recording this podcast, I'm sticking with this Plato quote, just because a lot of things are going to start coming out in the news that have really been obfuscated, and a lot of subterfuge globally to keep these things out of the media and of common parlance, and that is going to change. So I wanted to give you guys this, because if you have been following and you've been kind of awake, you'll understand this feeling. Those who are able to see beyond the shadows and lies of their culture. We have been told that everything is fine and that things are going to continue on as they have been, and that is not true. That is unequivocally, economically, mathematically, and financially not true. So therefore, it must be false. Just simple logic. If it's not true, it is false. There is only binary zeros and ones in life, true, false. That's it. True would be a 1, a 0 would be a false. I love statistics. If you've never taken a quantitative analysis class, you're really doing yourself a disservice if you are a mathematical brain like I am. Stats is freaking awesome, because it combines math with logic and creates statistics and probabilities. It's amazing. So anyways, the bottom line is, if you are in a culture that's lying, we are there now. This is where we are. We who are able to see beyond the lies and beyond the shadows of reality, we see through to reality. We will not ever be understood, let alone believed by the masses. This is one of the things that I had to really dissect. Did I want to go out there publicly and start speaking truth of globally what's happening? And a very tough decision, but there's so few voices that actually do speak truth, that it was not a choice. It had to be done. So let's keep going. Let's get started with this week. All right, this is Peter Schiff. A higher debt ceiling won't solve the problem. It will make the problem worse. So I want to talk to you guys first about debt ceiling. Obviously, we have Speaker McCarthy coming out yesterday on Monday, being asked by a reporter live, has Biden reached out to discuss the fact that the House has passed a budget bill and moved it over to the Senate? And Speaker McCarthy said President Biden has not called him to even discuss it. I was actually being interviewed on television. I said, President Biden doesn't have that option. The Constitution clearly lays out that the House controls the purse strings of Congress. And so he has to have conversations. The House is the budget maker, the purse decider. And so Biden doesn't have the authority to not talk to them. Biden really learned this strategy and this lesson in 2011 with Barack Obama. So Obama came in January of 2009. And just like Biden, he had two houses that were both blue, Democratic. And then when the midterm election came in 2010, when he started 2011, the House went from blue to red. And we had the same exact thing. We had a debt limit ceiling problem. Now, Obama did negotiate with the Republicans, and yet Republicans felt like they had just gotten elected to go to the House and put in some fiscal discipline. So they weren't willing to really compromise on that. And that kind of stalemate situation reminds me a lot of present day 2023, because in that situation in 2011, we got a budget deal literally 3 days on the Friday before the Monday when we would not be able to pay our bills. 3 days before an actual first-time default of the U.S. dollar obligations by the federal government. And we then dealt with it. And the result was that S&P downgraded our triple bond grade rating, and it cost us billions of dollars in extra interest for what we were going to do anyway. So this is not a solution to just raise the debt ceiling. What Biden has done is he has said that I'm going to disassociate discussions around raising the debt ceiling from actual discussions around controlling spending. In other words, I just want to discuss with you raising the debt ceiling because you're holding our country hostage, and I'm not going to actually discuss with you where we can actually be fiscally responsible. So that makes no sense, because if you can, look, we had this problem in 2011. Fast forward literally 12 years later, 2023, exact same problem. Have we slowed down our rate of spend burn? No, we haven't done any of that. The situation is only much worse post-coronavirus stimulus and all the things that happen globally with that. And yet we still are not having these discussions around fiscal discipline. If we're not going to have it when the Congress is turned over, at least on one side, at least the House side, when are we going to have the discussions around fiscal discipline? If not now, then it's going to be never. And basically, you're just asking for a blank check, Mr. Biden. And the answer by the American people has to be a resounding no. No, no, and no. This administration, I don't have a slide on this because I have a very specific runway today, but this administration literally is rewriting the way that financial credit decisions are decided by surcharging people that have 680 credit scores on mortgages and above to help offset fees for those borrowers that would be considered subprime, less than 680, that have credit issues. This whole world is getting turned upside down. Let's move on. So I just wanted to remind you guys, here's a Reuters report from January of 2023 that just basically let us know that Yellen stated that June was our debt limit hike, the limit, basically the X date, the date where we can no longer actually pay our bills. So it's, again, they have waited to the last minute. Here we are in May, and they have waited, and they know that Yellen said in January, of course, right where our debt ceiling has already been hit, you guys. We've already hit the limit. We are using what we call extraordinary measures right now to continue to pay the bills. We've been doing that since January, and Yellen warned us of that since January. So the fact that they've literally done nothing for 4 months, and now we're in May, and the problem's happening in June potentially. I think she's a little bit light on her time frame. I really think it's closer to September, but we have enough things happening in June. For example, the LIBOR to SOFR switch globally, and that alone is another liquidity event. So we've got big issues, huge issues for June. We shouldn't save this to June. Last week, Moody's downgraded another 11 regional banks. 11 regional banks were downgraded last week. This was before the actual buyout now and then collapse, FDIC receivership collapse, and then buyout by JP Morgan of First Republic. So this was just talking about the two that had failed already last week. And now we know that we do, in fact, have First Republic. I want to give you guys some context on First Republic. In the first quarter, deposits were shrunk or withdrawn of $104 billion. That's 40% of their overall deposits. But I want to give you kind of a perspective of that, because when you look at Credit Suisse, which was bought out obviously by UBS earlier this year, they had outflows of $69 billion. So I just want you guys to have a mental perspective of how big a mid-sized bank actually is when Credit Suisse bought by UBS as it was collapsing, as we knew it. What I said, I told, it doesn't matter. The bottom line is we saw the indicators for Credit Suisse. We knew it was not going to make it after all its long history, and UBS definitely bought it out. But look at that. It only lost $69 billion in reserves, and it was bought by UBS. Whereas First Republic, which is what we call a regional bank, basically lost $104 billion in deposits. Now, I want to talk to you about the JP Morgan actual deal, because not only is JP basically acquiring $92 billion of deposits, but they're doing it through getting partially financed by the FDIC. the FDIC is giving them a loan of $50 billion to acquire First Republic. Now, let's not forget that we had three major banks, including Bank of America, recapitalized First Republic by $30 billion as Signature Bank and SVB Bank were collapsing in March. So basically, First Republic should have also been a part of Signature Bank and SVB Bank that already collapsed in March. But because they had three banks backstop them to the tune of $30 billion, they were able to survive until the end of April. And 6 weeks later, in which case they were no longer able to buy. Now JP Morgan's coming in and acquiring them after the FDIC started receivership. However, the FDIC is partially financing that by lending JP Morgan $50 billion for that acquisition. So what I'm trying to get you guys to see is that ultimately the taxpayer is still implicated here and still on the actual hook. So it's a problem. It is a problem. And I would describe this whole situation, especially with Moody's downgrading more banks, that it is just a delayed reaction to the beginning of the tightening in March. But really we saw, and this is an article from February out of Zero Edge, and basically Zero Edge, and it says, banks tightening consumer credit may be what triggers recession. This is a chart. I showed you a chart 3 weeks ago, a technical chart from the Fed that showed the bank lending requirements have immediately just shot straight up. Anytime we go into liquidity-based events, lending constraints tighten immediately, and a lot less groups, not only corporations, but a lot less individuals have access to credit to continue their operations as usual, which only further exacerbates any kind of economic anomalies and disruptions that we're already experiencing. Here's the M2 money supply. We've been talking about this since the end of 2022, September. We've started to see a downtrend, which means that liquidity is drying up and the M2 money supply is shrinking when normally in a stimulus-based economic system, which is what we have, you would always see additional growth on the money supply. So we do expect the Federal Open Market Committee meeting today and tomorrow to result in a 25 basis point hike. We're basically 90% on the CME Group analysis of an economist expectation is that we will get another 25 basis point hike. And that has to make you stop and pause and ask yourself, like, why? What's going on? The fact that we are hiking into recessionary indicators now with a death cross on the S&P, the fact that we are so tight on credit that where the money supply is contracting, that we're seeing stagflation type indicators now where we're starting to see the economy slow while inflation continues, which of course does happen when you've printed too much and had too much stimulus. So the fact that the Fed is tightening into this tells you a really hidden message, which is Powell is not ready to send the signal to the world that the dollar is having some struggles, that he has to continue to send the message that the dollar is strong, that will continue to bring dollars or funds from the globe to the United States because they still perceive the dollar to be strong, even though de-dollarization has absolutely started in earnest. And I will just give you this headline from this morning. The banking collapse of 2023 is now bigger than the banking collapse of 2008. We had 25 banks that collapsed in 2008, yet literally since March, we've had the second largest bank failures in our history, only surpassed by Washington Mutual in the GFC and the global financial crisis of 2008. So we've already seen three banks that have had more assets than all 25 banks that collapsed in 2008. So you guys, we literally are here at a precipice, and I would encourage you to make sure you have some funds at home. Coins, I like some physical metals at home. It doesn't have to be the marked up, printed, actual official coins like Cougarans or Eagles or anything like that. You can just have your weight of your pure weight stamped, and that will be good and sufficient for purchasing things if we go through some kind of liquidity crisis event. beyond what we're already going through, which is that you don't even have access to funds in your account, a kind of a cash freeze. So I like coins for that. I've had a lot of interviews recently about what do I feel about banking. Listen, I definitely do not want to cause you to go and take all of your money out of the bank, but I am a much bigger fan of credit unions right now because they are not FDIC insured, they're NCUA. It's a different system. Credit unions are what we call mutual corporations or mutual companies where they're owned by their shareholders, their deposit holders. That's the cool and unique thing about credit unions, and it's not a part of FDIC. So just in general, when we see so much stress in the FDIC world with those kinds of banks, I would be looking for alternatives, and I definitely would have some physical metals at home for when things potentially go south. What we're expecting, and you guys know that we've been expecting, is a system collapse of some kind, whether it be a liquidity-based event, a LIBOR to SOFR event in June, a debt limit event, a Chinese escalation of Taiwan event, a Russia-Ukraine, NATO-Russia proxy war event, whether it be economic data, whether it be just a massive amount of banks all of a sudden collapsing, whatever is the match or the kick to the first domino, we are so vapor thin right now, not paper thin, vapor thin right now with the stability of the global economic infrastructure that anything that changes and pops off, I think, will set off a standard deviation event. I think a three standard deviation event. And that is a problem big time for the United States. We are vapor thin right now. And this is where we are. So you can do yourself and your family some favors by not panicking, just preparing. It's very simple. I wouldn't be doing this podcast if we were beyond the point of actually having any positive impact in people's lives. You can prepare. You can look at your bank. You can say, am I at a big bank? Am I at an original bank? Am I at FDIC? Could they do a bail-in? Go back and look at my podcast talking about banks and FDIC and bail-ins that was publicly announced in November 2022. Since the global financial crisis, banks have the ability to bail you in. If you don't know what that means, you need to go look. I can't rehash all the information on every podcast. So find out what a bail-in is. Find out what it means to you and do something about it. I hope you guys are having a great week. I will definitely spend more time with you guys as this year unfolds. It's just really busy right now, a lot going on. And this is what I do for fun to keep you guys that are not a part of my world or my practice, just give you some help and some tips. And of course, I do that with all of the other media interviews I do every week. So I do try to get you guys information, but just bear with me as I am slammed with my business right now and things that are happening with that, obviously globally. Take care, everybody. Hope you're having a great week. And until next week, I'll see you. Take care.